Shri Gurubhyo Namaha children. Now we are related entrepreneurial planning and we are going to see financial planning here in this class. So previously we saw what are the contents of business plan, okay, and what are the parts and components of the business plan. And we started off with the details of the entrepreneur first. The first part is the details of the entrepreneur. The second one is the business venture, nature of the business that you're going to carry. Third, we saw the production plan. Okay. What are the raw materials that you'll be requiring and where you'll be getting it? And what type of business, whether it's a trading business or whether it is a manufacturing business or whether it is a partial manufacturing, partly you're going to do a contract. And then we saw operation plan. How are you going to do the operations? How are you going to carry out the process of manufacturing into the factory? The flow of work in your factory? How are you going to control the manpower? Then we saw the organization plan, the type of organization that you're going to choose. Alright, next we are going to see the most important plan, that is the financial plan. Okay, what is financial plan? Financial plan is one of the most important plan for your business. See, any type of business you take, irrespective of the type of organization you take, you need money. Okay, finance is one of the most important criteria for any type of business. And without money, though, you're not going to do anything. Right? So, financial plan is a projection of the key financial data about what? About the potential investment commitment needed for the new venture. So, the potential investment commitment, what is that finance needed for your new venture? And economic feasibility. What means the economic feasibility? Whether you will be able to carry on the business properly. Okay, your weaknesses, your strength and weakness. Okay, your strength, your weakness, your opportunity, and the risk associated with the resource that will be needed to be implemented to make your business a success. Okay, so feasibility, whether it is feasible to run the enterprise, whether if you start the business you will be making profit. Hmm. Next, the entrepreneur and the investor will have a clear picture. So investor ultimately is a stakeholder of your company, right? You should know whether, if at all he invests in your business, whether he will be making profit. So how much funds are required? That's what you should know. Okay, you should have a clear picture. You should have a clear picture of how much fund is required. Where will funds come from? Okay, the resource. Okay, where are you going to get the fund from? And how are they going to be distributed? How much for the fixed assets? How much is going to be invested in working capital? Okay. So the amount of cash available, how much is available now? How much is borrowed? So how much is there in hand? How much is it from? Like, why you cannot get from the bank anymore. Okay, you're going to go public. Okay. So how are you going to get the cash? The general financial well-being of the new venture. That is the probable revenue forecast for the first year at least. So revenue, what is revenue? So revenue means the total, the permanent income we'll be getting. The income that you're going to get from the business. It's called as revenue. So finance is the most important prerequisite. So what do you mean by prerequisites? What do you mean by prerequisite? Something that is necessary for something else to happen. Prerequisites, which is definitely required. So finance is the most important prerequisites to establish an organization. Without finance, you cannot start an organization. Before you start the business itself, you'll be making a feasibility study. Okay, that is the preliminary expenses. Before you start the business, you should know whether if you start the business, you're going to invest 100 crore, 200 crore, and all. Like, how are you going to make? If you don't make profit, then you will be nowhere. So definitely, you should have a feasibility study. So finance brings together what? Man, material. So man. So you need human resource. It's not enough just if you have money, you can run the business. You should get the right person. If you want to get the right person, you have to invest. Okay, material, your raw material required for the business. The machines, the technology, maybe it's within India, outside India. So all the technology and know-how. Methods to produce. So maybe you're starting a biscuit factory or a chocolate factory. You're going to Denmark and you're going to import all the machineries and technology from there. Or you're going to get the best baker. Or you're going to start a cake factory. Or you're going to start a tire rubber factory. Or you're going to start a chemical factory or a textile factory. So whatever it may be, you need all this is very, very important. So if you have finance, you can bring man, material, machine, and method of production together. Only then you can continue with your business. So what is financial plan? The timely availability of funds in the right volume. What do you mean by right volume? So is the key to entrepreneurial success. Entrepreneur should develop a sound financial planning discussing what? Now, what do you mean by right volume? See, the amount of finance that you have should not be in excess, or it should not fall short also. If you are having a deficit, then I think it's a problem. See, if you want to buy a raw material, maybe there's a sudden demand, there's more demand, and definitely you have to supply your finished product. And if you don't have money, so you should always have a reserve. If you're going to have excess money simply just like that it is in the bank, then that is also a problem for you. Right? So you should make sure you have the right volume of finance. So that is the secret of success for an entrepreneur. Okay. The entrepreneur should develop a sound financial planning, discussing what? The financial requirement, how much you'll be requiring, how much you'll be requiring per day. So you have to discuss on different performers. What are the different performers, different departments where you have to invest your money. Sources of raising fund. How are you going to raise your fund? Maybe you are having owner's capital. What do you mean owner's capital? Owner's capital is nothing but your share capital. It is your preference share capital and your equity share capital. Okay. Okay. Preference share capital or equity share capital or your the profit that you have earned, that is your returned earnings. Okay, the accumulated profit that you have get, that is also your the ownership capital. Okay, borrowed funds. To borrow from private banks, also human banks, or the investors. So how are you going to, the total amount you're going to borrow? So the way you're going to raise your funds, the exact assessment of revenue, how much revenue, income you're going to make on daily basis by buying and selling or manufacturing and selling, cost of the product, the profits you're going to make, the cash flow dynamics. Cash flow dynamics is your cash inflow and your cash outflow. Okay. How much of cash is going to go out? Okay, how much is there in your hand? See, one of the main reasons why many of the huge companies have failed is because of this cash flow dynamics. Okay? The inefficient cash in hand to rotate and to pay off the salaries of the employees and to pay off the suppliers. So when you don't pay your employees, when you don't supply the goods whenever you're not able to purchase the goods and pay the suppliers on time, then you're black mark, isn't it? Like how you issue a check and if it's going to be bounced, you have a bad reputation in the market. That's why you have an overdraft facility, so that your check is never bounced. Once your check is bounced, then you have a bad mark in the market. Your name is spoiled. And people say, "Okay, don't have business, don't have business because he's not financially sound." So likewise, your cash flow, you should have a proper cash flow, and you should make sure there is a balance maintained. Okay. Now next is stock inventory loans. Stock inventory loans is nothing but advance loan. Again, in case you're going to start a factory and to reduce the cost, normally you'll be right here, you'll be purchasing the raw material in bulk. So you may have to invest more on your working capital. So what is working capital? Working capital is the normal capital that you require to run the day-to-day affairs of your business. Right? So you may invest more amount on your raw material. If it is available suddenly, you may take and you may store your raw material and keep so that you reduce the cost of production. Right. So when you have to do an activity like this, you should always have a reserve amount in advance. So that is called a stock of inventory loans. Okay, that's one of the most important thing that area you should look into and make sure you have advanced loan in stock so that you meet the emergency needs. And sometimes you not have the liquidity in case you're going to invest in your raw materials, and that is very important to reduce your cost of production, right? So you may invest a lot of money in this, and your liquidity state might be very poor. So you should make sure you have advanced loan in hand, so that whenever there is a crisis, you can always go. And so revenue, fund, and investors, they're all three of them are interrelated. Your fund that you have, the amount that you have invested in your business, very required for your business, your income. Because actually revenue minus all the expenses and the cost is called as income, right? So total revenue, the every day whatever you're buying and selling, the activity you're buying and selling, the daily income that you get, okay, that is your revenue, income for your investors. So all these three are totally interrelated in a business plan. Next. How the entrepreneur plans to meet all the financial obligations and maintains liquidity. So how much your current asset, do you have current assets to meet your current liability in order to either pay off your debt or provide good return on investment. Okay, good return on investment, ROI. Your net income over the cost of investment. So several financial projection techniques and tools are made use of by the entrepreneur. So financial projection techniques and tools. So different ratios you prepare, and to make sure before you start the business itself, you'll be preparing a financial plan which is that is a 3 years performance at least. When you're investing a huge amount, you have to prepare a business plan for at least 3 years, projecting your profit. This much I'll be investing, this much I'll be investing in different areas, department, my assets I'll be investing this much, and I'll be investing on tools this much, I'll be having a working capital this much, this will be advanced loan, this is my source of capital, and all that you have to decide well in advance. Okay. So in general, the financial plan will need 3 years of projected financial data to satisfy any outside investor. So you need fund, right? So you have to attract the investor. The components of financial plan. So what are the components of financial plan? Components of business plan, major financial items that should be included in your business. So what all? What are all the components? Okay, what are all the components that you should have? So what do you mean by performer? See, performer is, what do you mean by performer? Performer is the order. It's a document prepared in order to show the usual way of doing something or to provide a standard method. So it is a document. Performer is a document. It's a document prepared in order to show the usual way of doing something or to provide a standard method. To provide a standard method. Right. So performer investment decisions, performer financial decisions, performer income statements, performer cash flow. You have to make a document with a standard method. Performer balance sheet, break-even analysis. We have already seen break-even analysis. Right? How to resource management, the types of resources. Okay. The economic and social variables. So we are going to see in detail all the subdivisions. Now to start with, you're going to see the performer investment decisions. Where are you going to invest the amount? Okay, in what type of fixed assets you'll be investing the amount? Your machinery is a fixed asset, your land is a fixed asset, your plant that you're going to have in the factory is a fixed asset. So this part of financial plan explains how the entrepreneur's funds are invested in different assets so that the enterprise is able to earn the highest possible return on investment. That is your ROI. Your net income divided by your cost of investment. So, an estimate of various components of capital nature, that is, the fixed assets and the working capital, should be clearly mentioned in this part of your business plan. So, what are fixed assets? What is working capital? Working capital is the capital that you require on a day-to-day basis to run your business smoothly, right? So, next. So, carefully, clearly, and sequentially, the entrepreneur should, okay, he should make a note. So, he should make a note of what? He should make a note of how much investment he should be investing, how much money he should invest on land and building, how much he should invest on the plant and machinery, how much you should invest on installation? Okay, what is the amount you should put on installation? In preliminary expenses. Okay, so what is the amount? Preliminary expenses means what? Before you start the business, you will have a lot of expenses. You should go for a feasibility study. Okay, you should give the experts. You should give the experts money, okay, fund to know whether if you start the business, whether it will be a success. What are the weaknesses? What are the strengths? What are the opportunities available? Okay, what are the risks available when you start the business? So you will have a lot of preliminary expenses before you start the business. So margin of working capital, expenses on research and development. So any big business you start, company, see they will be having a research and L&T. They have a research and development, L&T department, research and development, R&D department. Why? Okay, where which your company has an R&D department, they normally do research. Like what is the future, what are the what is happening, how to improve the quality of the products that they are dealing with. So that's a very important division that we should have in our company. So the expenses on research and development. So it's not a waste. Then investment in short-term assets like what? Raw materials also, level of cash, liquid cash, etc. Okay, so this is about the total assets that will be invested. How much money are you going to invest? Next step. Next performance, what next document that will be maintaining is the investment decisions. So this helps to understand the total amount of finance required by the entrepreneur. For what? Inadequate fund or excess fund both have a capacity to severely damage the financial future of the business. So excess fund if you're going to have, you are blocking the cash. You are actually dumping the cash in your bank and not making use of it. So unless the money is rotated, it's not going to improve your cash flow, right? So you cannot just like that have fund and just keep it not operated. So you should have an operating capital. So if you are going to have shortage of money, so if you're going to have a shortage of money, suddenly you need raw material. Then you stop the business. Your factory is not running for 1 or 2 days. Even if it stops working for 1 month, it's a loss for you. Your cost of manufacturing will increase. Okay. So the labors they're going to be idle, isn't it? So when labors are going to be idle, whatever you have to produce in that particular day, you will fall short of it. Then again you are wasting your manner. Okay. So per day, per hour, in 1 minute or in 2 minutes or in 5 minutes, how much a product a particular man is, a particular labor is able to produce. So all that is very important. So if you are falling short, you're falling short to pay your employees, you're falling short of money to buy raw materials, and in the you wait for the last. You don't have any stock inventory capital. Like you don't have any advance loan in your hand to meet your expenses. That also will damage the reputation of the business. So any excess money which you have kept idle, you're not using it, not in rotation, which is going to, which is you're going to end up with a loss. Okay, so if you are having a shortage, also you're going to have a serious problem. So inadequate fund or excess fund both have a very adverse effect. It will damage the financial portion of the future of the business. Therefore, these decisions must be taken with utmost care. Next. This section summarizes all the projected sources of funds available to the venture to raise finance from which you have already studied in previous class. We have studied about all this. In our previous class, we have studied about the sources of fund. How are they getting owner's fund? Owner's fund is now either share capital. Share capital is what? Either it is preferred share capital or equity share capital. Now again, or it might be profit. Okay, profit that they have earned over the period. So weekly earnings. Next, what borrowed funds? Borrowed funds can be either from the bank or financial institutions or from by investors. Hmm. So next, the entrepreneur's job is to ensure that this section of of this section as a proper mix. Okay, it has a best overall mix of financing. It's very important that you have a proper mix of this particular section. So the mix of finance for the enterprise, so that you have a best overall mix of the finance. How the cost of capital and the financial risk stands minimized. So what is cost of capital? See, instead of investing in this business, if you had invested the money elsewhere, what would have been the rate? Okay, what would have been the return on investment? Return on investment and profitability stands maximized. So the cost of capital and the financial risk is minimized. Cost of capital and the financial risk is minimized, and the rate of investment and profitability is maximized. So the entrepreneur's job is to ensure the selection of best overall mix of finance for the enterprise. Fine. So what is cost of capital? Cost of capital of an investor is equal to the return an investor can fetch from the next best alternative investment. Fine. If he is not investing here, if he has invested elsewhere, the fund. Okay, so fund I said it can be either borrowed fund or the owner's fund. If he has invested this fund, owner's fund elsewhere, what will be the return? Right. So return of investment. Return of investment, we have seen how to calculate ROI already. Net income divided by cost of investment. So ROI measures the benefit or an investor will receive in relation to the investment cost. Okay, children. In the next class, we'll be seeing the other documents. Right? Thank you. We'll see you in the next class. Go through the lesson. Okay. Next class, I'll be giving you the assignments.